All right. Well, I see that we still have folks joining, but according to my watch, it is right at the top of the hour. So good afternoon to everyone and aloha to those who might be joining us from Hawaii. Thank you for joining this latest installment of our Harvesting Value webinar series. Our goal with this monthly series is to provide you with information and resources to help make really important decisions for your operation. My name is Jacob DeBoer. I get to moderate the conversation today, and I'm part of the marketing team at American Ag Credit, based out of the Great Central Valley of California. I feel especially privileged to bring this topic to life as personally, my family has been on a farm succession planning journey since way back in 2018. In some ways, it feels like just yesterday, but it has definitely been a journey. Before we dive into our succession planning presentation, I'd like to remind everyone of a few housekeeping items. You are welcome to submit questions for our speaker at any time during the presentation using the Q&A, not the chat, the Q&A feature at the Zoom taskbar that's going to be at the bottom of your screen. We will do our best to address as many questions as possible at the end of the webinar, and we'll follow up to those which we might not have time to get to. Additionally, this presentation will be recorded, and we will share a link to the webinar with all attendees and registrants. It will also be posted to our website if you'd like to visit it there, or even send that link to those that you might think would find the content relevant. We have not yet had the pleasure of working together. American Ag Credit has been part of the farm credit system for over 100 years, and we have the most diverse commodity portfolio in the farm credit system, which allows us to adopt and evolve ag finance best practices and innovation across different types of agriculture. Our presenter today is partner CPA for Genske Mulder, Paul Anema. Paul has been with Genske Mulder since 1996 and a partner since 2002. Right down the road from where I'm sitting here in Oakdale, California. Paul works closely with his clients to provide a wide variety of accountant, tax planning advice, and financial planning services. Paul will walk through how we start succession planning conversations and who should probably be at that table of conversation, as well as practical tips to consider when evaluating transition strategies. I do want to highlight today that we are not giving tax or legal advice, and every option really is different and unique. And it's important that individuals consult with your own team of professionals. In fact, the USDA cited that 97% of US farms are family owned. So really that just underscores the importance of everyone engaging at an individual level for what makes sense for your path to succession planning. Thank you for joining us this afternoon, Paul. Paul, I'll go ahead and let you get started with your portion of the webinar.
All right. Thank you, Jacob. I think Jacob hit all the salient points of my career so far. I'll add a couple. I graduated from Dordt College, which is for those of you who've never heard of it, is in Northwest Iowa. So I grew up here, went to college out in Iowa and came back. But most of my life, I didn't grow up on a farm, but I've been surrounded by the farming community. And I've grown to love the farming community. It's within our firm, probably 80% of our clients are ag related. We have a heavy concentration in dairy, but as our dairy clients transition, we're getting more and more involved in row crops and almonds and everything else in between. So the farming community is something I'm very passionate about, and I'm really glad to be able to hopefully help some of you in this very important subject. So succession planning is something that is one of the more challenging areas of my profession, and I think it's one of the more challenging areas for a lot of my clients. Most of my clients have spent their life building up their business or building on the business that their parents started. And as hard as building a business is, dealing with the succession of that business can be even more challenging, and for a variety of reasons. And so it's not an easy subject, and there's not a blueprint that you go start with step A, finish at step Z, and everything in between is very clear. It's difficult, and there is no cookie cutter way of doing it. And so what I want to do today is raise a lot of the issues, the who, the why, the how, and some of the tools that you can use in succession planning. And as Jacob alluded to, every plan is going to be different, and that's what makes it so challenging. So I'm going to start with the why. Why do most of my clients get into succession planning? Why is it important? Number one, a lot of times listed is to ensure the continuity of the business. If you don't set up a good plan for succession, the likelihood of that business continuing beyond your lifetime is very slim. And I'll point this out. Most of the succession planning that we deal with is generational. It's from father to son. And so that's mostly what I'll be talking about. But if you're looking at something laterally where you've got a valued employee that's going to actually be taking over the business, a lot of the concepts are the same. And so when I talk about next generation, it could also mean something beyond generational. It could be bringing in a key employee as an owner as well. So the concepts are the same, but most of my clients were dealing with generation to generation. And so biggest reason why is to ensure that the business continues. You've spent your whole life building something and you want to make sure that it continues. It's something you should be proud of and thankful for, and hopefully that it will continue beyond your lifetime because you put a lot into it. And so, that's the other thing I'd point out is congratulations. You have something that's worth preserving. You've built something, and that's very important to remember. And the fact that you're having this conversation or you're starting to think about it puts you ahead of a lot of people, and it goes a long ways towards ensuring that continuity. Sometimes the succession planning is part of growing the business. I know with a lot of my clients, when I first started, it was not uncommon that we would have 3 families supported by a 500 cow dairy. Well, that doesn't really work very well in California anymore. In fact, there are very few dairies that size, let alone supporting 3 families. And so sometimes the point of succession is we're going to bring in the kids and they're going to help us grow the business to 1,500, 2,000, whatever the number they deem appropriate for the business environment. Another reason is to minimize estate taxes. A lot of you have spent a lot of time building this up and you don't want to give a large chunk of it to Uncle Sam, and that's understandable. I'll put in a caveat here. Most clients that I deal with are not having to deal with the estate tax per se, but there are elements of the estate tax that are still going to be impactful, even if you are not going to be subject to the estate tax. I don't want to get into the weeds too much of it. I have some slides at the end, and that's a conversation you should have with your accountant, is whether or not you'll be subject to the estate tax. Currently, the limitation is around 13, 14 million per person. It changes every year because of inflation. And so a married couple, if you're under 26 million in net worth, you're not going to have any estate taxes. That doesn't mean that the estate tax laws don't impact your plan, because there's something called step up in basis. And there's some significant tax implications that come along with that, even if you don't owe the estate tax. You're going to hear a lot about the estate tax in the coming years, because in 2026, that 13 million per person or 26 million per married couple is going to drop back down to about half of that. And that's a very likely event. And so you're going to hear a lot about that. And so my advice on that is talk to your accountant about whether or not you're going to be subject to that and how it's going to impact you personally. Because the decisions that your neighbor makes, or that the farmer next door makes, or your cousin made, they're not going to be the same for you. And so it's really important to understand where you're at in relation to the current estate tax laws and the projected estate tax laws. But that is that is something we deal with, but it's not as common as the other issues, growing the business and continuity. Another reason why is to minimize family strife. I've seen too often where lack of planning, mom and dad are gone, or mom or dad are gone, and it wasn't clear what was supposed to happen. And you end up with siblings that end up in court, or just even with hurt feelings, and families no longer getting together for Thanksgiving and Christmas. And Most people want to avoid that, and I think that's an important thing. If you have a good plan, the kids may not always like the plan, but it's clear. And when mom and dad are gone, generally it works a little better if they're just a little miffed at mom and dad who are gone than if they're arguing with their brother or their sister over what mom and dad put in place. Also, reducing leadership burdens on current owners. A lot of times, current owners want to start backing away from the business, and so that's a process. It's not something you can just step away from, but as you step away, bringing in new owners to take up some of that responsibility and lighten the burden on owners who want to retire or have less involvement. Also, it can be a way of retaining top employees. This is not a common tool that's used, but it is used effectively in many cases where if you have top talent, making them part of the ownership structure helps to ensure they don't go anywhere. So then it brings us to the question of how. And this is a really important thing that I always try to stress with my clients. Always start with the end in mind. Ask the question, where do I want the business to be in 10 years, 20 years, and after I'm gone? I think too often we get caught up in the weeds of the tools of succession planning, and we don't spend enough time thinking about what is it we're trying to accomplish. If you don't know where you're trying to go, you really won't have a good idea of how to get there. And again, your destination might be very different than your neighbor's destination or somebody else in your family's destination. You've got to decide where it is that you want to be in 10 years, 20 years, and beyond, before you can really start deciding what tools to use and how to utilize those tools. Some of the tools we'll get to can be utilized in very different manners. And so too often I find people looking around to their left, to the right and saying, well, you know, so-and-so did this, that they seem to be a good business person, so I better do that too. I've had clients that have gone out and started up a corporation because their neighbor told them that it was the right thing to do. And I try to explain to them, your neighbor maybe had a very good reason for starting a corporation, but it doesn't fit your needs, and you've just created an unnecessary entity that's going to cost you $5,000 a year. And so it's important to keep that always in the forefront, is what is it you're trying to accomplish and where do you want to go? Looking at the who. It's really important to surround yourself with people that you trust. And I always tell people, if you don't have a team that you can trust, you need to get a new team. Or you need to bring the people that you have more and get them more involved so that they can give you the advice that that you might not be able to get somewhere else. And that involves usually your attorney, your accountant, your banker. Those three, I would say, are pretty indispensable, in the sense of there's a lot of overlap between the legal and the financial. And your attorney is going to tell you what you legally can do, what you legally can't do, how do you protect your assets. Your accountant's going to tell you the tax implications of those decisions. And your banker is going to tell you, you know, some of the things that you can and can't do within the confines of your lending agreement. Sometimes you'll bring in a life insurance agent. Not always. There are situations where it's not needed. There's some times where it's very needed, but I would start with your attorney, accountant, banker, and then consider bringing in a life insurance agent, possibly an estate planning specialist. And then another question is whether or not you want to bring your family involved, bring your family in on the decision. And that's something that you've got to weigh within your family. I've seen that go very well, and I've seen it go very poorly. And so, but it's something to consider. Do you want the kids involved in the discussion? The pros of that is then they know what their future is. They know what their role is going to be going forward. They know whether they're going to inherit the farm or whether they're going to have to buy the farm from siblings. They also know if they're going to have to buy it at what cost and what terms. The downside of bringing kids in early is they might view it as a democracy where they get a vote, and it brings out a lot of arguments. And so I think you have to be very careful on that, but I've seen it work well, and I've also seen it work poorly, but I think it's worth considering. And in rare cases, I've had clients that have brought in family counselors to help through that. And yeah, that seems like a lot. But again, you've built something of wealth, you've built something of value. And if you want to preserve that value, you need to surround yourself with the right people. After you've decided what your goal is, you've decided who's involved, it's very important for you to set your priorities. Your accountant shouldn't set your priorities. Your attorney should not set your priorities. You need to set your priorities. And there's a number of priorities that you need to consider. And I would take these and possibly a few others if you can think of other priorities that you want to consider as you're trying to get to your end destination. You've determined you want to get from point A to point B. Now, here's some priorities. How important is control to you? How important is personal financial security and risk avoidance, fairness, family harmony, legal protection, simplicity, and minimization of taxes? And if you say, boy, those all look great, give me all of those, please. Unfortunately, that's not the way it works. Most of these have a trade-off, and that's why it's important to decide what's most important. For instance, if you decide that simplicity and minimization of taxes are both your top priorities, those are going to be in conflict. Quite often, if you are looking at an estate tax situation or an income tax situation, but you want to keep things very simple, those two don't go well together. And so you're going to have to pick one at the expense of the other. Sometimes personal financial security and risk avoidance are going to very much rub up against continuity of the business. And what I mean by that is situations like I alluded to earlier, where if you've got 20, 30 years ago, if you had a 500 cow dairy and everything was paid for, you were fairly financially secure. That was not a risky position to be in. But if you looked at it and you had 2 children that you wanted to stay in the dairy business in California, and so you wanted the business to continue, that financial security of having a 500 cow dairy with everything paid for was going to have to take a hit because you were going to need to grow. And in order to grow, you're going to have to take on more debt. And that was going to create risk and jeopardize somewhat your security. And so that decision of what's more important, continuing the business, meaning we're going to have to leverage up and we're going to have to take on more debt and make some improvements, or you know what, we're just going to keep everything here, and the minute things get tough, we can just sell everything and we're not going to end up in the poorhouse. And so deciding those priorities is going to be really important for you to do early on and to communicate that with the team that you've assembled, those people that are giving you advice, because everybody has their own personal bent. A lot of accountants are fixated on minimization of taxes because that's how we've been wired. The lawyers are going to be fixated on legal protection. And so if simplicity is really important, you're going to have to give up something on legal protection, and your attorney is going to push back on that. That's where his job is to tell you what the risks are and for you to decide, I'm willing to take that risk because I don't want to have this multi-layered entity with 5 different tax returns and 5 different tax ID numbers. I just want it nice and simple the way I've always had it. He can warn you about the challenges with that, but then you can push back and say, I understand, but it's more important for me to keep things simple. Same thing with your accountant. If you want to minimize taxes, your accountant can help you creating some elaborate structures to help with that. By the way, there's no getting out of taxes. The only way to get out of taxes is to, number 1, don't make money. Number 2, cheat like crazy. Or number 3, if you grow continually, you can push off taxes, but ultimately it does come back at you. But our job is to try to help you minimize that. Anyways, that's another tangent. So again, understanding the conflict between some of these priorities and understanding what's most important to you will then help those who are advising you come up with a plan to get from point A to point B while trying to preserve as many of those priorities as possible. Other questions. You've got to ask yourself, how many families can this business support? Because if the business is capable of supporting 2 families and you've got 5 kids, you've got a problem. You're going to have to address that. What about human capital? And what I mean by that is, we talk about our financial capital, land and cash and inventory, liabilities, financial assets and liabilities. Human capital has the same thing. You have a certain set of skills. That's probably why you have a business that you're worried about continuing, because you've done something right. And so you've got some skills, you've got some experience. And so looking at what does your company currently have and or need, and what will the company have and or need. If you are the owner who handles all of the financing needs, you're the one that talks to the banker, you deal with the accountant, and you're planning on retiring, who's going to fill that role? If you look at you're going to need to grow the business or transition. Let's say, again, back here in the Valley, we went through this with a lot of our clients where they decided rather than expanding their dairy, they wanted to transition into trees. Well, that's a very different skill set. But, like I had one client, he had a son that went to school specifically for that. And so they were planning for the future with that human capital need. I think you also have to ask your question whether or not the next generation even wants to be in the business. Doesn't happen often, but I've seen sometimes where, the next generation is really pushed into taking over the business when it's not really where their heart is. And it doesn't usually turn out well. And so I think you have to ask that question. You can also look at within the family harmony, what promises have been made. One question I often get when I'm meeting with my clients and they've decided about what's going to happen when they're gone. They're going to sell the business to child A or give it to child B. And I get the question, is that fair? And my response is usually the same of, I can't answer that. I don't know what conversations you had with your kids at the dinner table, when they were in high school. I don't know what was told to them when they graduated college or 3 years ago when you sat down and were talking about their future. So I think you've got to always keep an inventory of what promises have been made and look at that in light of all the decisions that you're making. I think another common question and or challenge is whether or not the current ownership, which is often mom and dad, are in agreement on how succession should happen. And if not, there needs to be some negotiation there. Because especially in states like California, typically it's community property and you've got to have both of the owners in agreement. And so there's got to be some give and take on that and make sure that everybody's got the same plan. There's a few different methods of succession, and there's actually quite a few more, but these are the main ones that we look at with our clients. When you've decided who's going to take over the business, how do you get there? You can do a straight sale. You can sell to one of your kids. You can sell to a stranger. You can sell to a key employee, but a sale is one method. Gifting is another. You can just give it to them. Doing a long-term lease is another tool, and a purchase option, giving somebody the right to buy. And then we use a combination of these. So I want to talk a little bit about what some of the pros and cons, and the list is much longer, but I'm kind of hitting the big ones because I want to hit the more common problems and opportunities. So some of the pros of a sale, when you sell it, the next generation has skin in the game. And I have a lot of clients who, even though they have an estate tax issue, and I've explained to them that, it'd be really beneficial if you gave a portion of the family farm to the next generation, They don't want to do that because it's really important for them that their kids learn, as they did, what it means to have debt. And so even though the debt is to mom and dad, they want them to have that. And so they want them to be invested. So that's one of the key pros. It also can provide for cash flow for owners who are selling. If you want to start backing out of the business and you want, one of your priorities is that cash flow, then a monthly payment from the kids is a good way to generate that. It often creates tax benefits for the buyer because when the next generation buys it, they get write-offs from that. It also can limit the potential growth of the seller's estate. If you have a business that's growing rapidly, let's say you're getting close to that estate tax limit, and your business is growing, by $1 million a year. If you sell it, a note receivable does not grow as rapidly as typically a well-performing business. Some of the cons, quite often it will, rarely does it not, create a tax burden for the seller. There's almost always tax problems when you sell. And that's the balance. A tax benefit for the buyer, a tax problem for the seller. Within the family, the net income doesn't change. And so there's actually times where that can work in your favor. If you are up against the estate tax, paying income tax can actually have a mitigating effect. And so there's times where that actually is a benefit, but usually the tax burden is a problem for the seller. It can also create a cash flow challenge for the buyer and or the business. Most farms are cash poor. And even though there's a lot of wealth there, there's not a lot of free cash flow. And so creating that burden for the buyer or the business can be sometimes problematic. It can also sometimes trigger property tax reassessment. And that's something that often gets overlooked. And so that's something that needs to be considered. Gifting. The pros of gifting is there's often no tax consequences for the seller. And similar to selling, the future growth will be outside of the seller's estate. Some of the cons: next generation has no sweat equity in the business. And perhaps the biggest one is loss of control. When you sell, provided you carry back a note, you still have some degree of control because by virtue of the fact that they owe you money, if they don't make that payment, you can, have means of recourse to take the business back. That all needs to be drawn up in the sale documents, of course, but by virtue of the fact that you still have the equity, you have some level of control. When you give it away, it's gone. It's out of your estate, but it's also out of your control. Also, the gifts can trigger property tax reassessment. So a long-term lease can sometimes solve some of these problems. The advantage of a long-term lease: very limited tax consequences for the seller. You retain the benefits of basis step up at death of the old generation. So that's part of how the estate tax will impact you even if you're under the limit. Typically in most states where there's community property, when mom or dad passes, there's a new basis in the property. If you have a lease and you still own the property, you still get that step up. And so there's significant tax benefits that come from that. It's also an opportunity for the next generation to test drive the business. If they're just leasing the assets, they find out what it's like to wear your shoes, to have to make the decisions. But it's still easy enough for them to, if they get 2 years into it and they just find out this was not what I envisioned, or you believe that they're not capable, you just end the lease and you retain ownership of the land and you find a plan B. Some of the cons of the long-term lease: you still lose some control. You own the assets, but if they don't take care of the assets, that's still going to fall on you. If that asset grows in value, the next generation loses out on that appreciation and your estate continues to grow. Some of that can be mitigated with a buy-sell agreement. And so that can be dovetailed. And that's where it's important, again, when you get into that meeting with your accountant and your attorney and your banker, it's much easier to then start kind of throwing out ideas that can address some of those. And you're never going to hit all of them. You're never going to be able to hit all of your priorities, but if you have enough conversations and enough planning, you can usually get there with some level of satisfaction. So some of the tools that we use, and again, this is, step 3 or 4 into the process where you've already decided where it is you want to go. You've decided who's going to be there. And now how do we get there? These are some of the tools: is a living trust and or a will. Most states, and again, talk to your attorney, but most states, I would recommend a living trust. It solves a lot of problems for when you're gone and can really help to avoid family strife. And it very clearly spells out, this is what needs to happen. An installment sale can minimize taxes. That's where you sell something over a period of time. So you pay the taxes over time, which will minimize the taxes and also minimize the tax burden. Dealing with entity selection, whether you use a corporation, an S corporation, limited liability company, or a limited partnership, along with buy-sell agreements. This all gets into the complexity level. If it's very important for you to keep it simple, these are probably going to be something you're not interested in. But for those of you who can stomach a certain level of complexity, the entities available can really help you accomplish some of your goals. But again, start with your end goal. My partner recently had a client that came to her and said, "Hey, yeah, I'm doing some planning. So I put my business into an LLC. Isn't that great?" And she said, "Well, why'd you do that?" And he said, "Well, because that's what you're supposed to do." And when they got done discussing, it turns out he didn't need it. And now he had an entity that he either needed to close down or he needed to keep filing returns for. And it was probably going to cost him about $2,500 a year just for having that entity that wasn't accomplishing anything. So these can be used, but you need to first find out why you're using them. And that starts with having your end goal in mind. All right. Jacob, how much more time do we have? Do you want to start with the Q&A now, or do you want me to keep going?
I think you should keep going. Maybe
All right.
10 minutes or so.
Okay. So I'm just going to give a quick rundown on what's going on with the estate tax. So the history of the estate tax, to give you some idea, is let me back up. The estate tax is roughly 40% of the value of the estate over the exemption amount. So back in the year 2000, the exemption was $675,000. In 2001, that exemption rose to $1 million. And in 2009, it was 3.5 million. 2010, it was 5 million or 0, depending upon when you died in 2010. In 2018, it jumped up to 11 million. 2024, it jumped to at the end of 2024, it's going to be, well, I'm sorry, for 2024, it is 13,610,000. And in 2026, it's 7 million-ish. We don't know because it's going to be cut in half, but it's also going to be adjusted for inflation. So that's just a guesstimate of what it's going to be. In order for that to change, it would require both houses of Congress and the president. And so just to give you some idea of quick math on how this works, let's say back in 2009, your estate was $10 million. You're a single person with an estate of $10 million and you died. You would have a $6.5 million estate. And you would pay roughly 40% of that in estate taxes. I say roughly because it's a progressive rate, but it gets to 40% really quick. So just a good rule of thumb is just 40% of the amount over the exemption. 2010, it was at 5 million or zero, because in 2010, we actually had a brief period where there was no estate tax. And a lot of people thought that was great. It actually, for more of my clients, worked against them. I had more clients that were hurt by that than were benefited by that. And kind of an interesting story, what prompted that to change, because we had a split government and you couldn't get anybody to agree on anything, was George Steinbrenner died. And when George Steinbrenner died and there was no estate tax, his estate went through at zero. So they decided we better fix this pretty quick. So then they came up with a $5 million limit. Then the Trump tax cuts jumped it up to 11.1, and then it's been just steadily rising since. The law for 2026 is set to go down to 7 million. So it would take the president and both houses to change that. So it's a very, very likely that this is going to go down. It was also set to go down in 2018 because everybody assumed that Hillary Clinton was going to win. And so there was a mad dash to be making a lot of significant estate planning decisions. And then when Donald Trump won and the Republicans had the House and the Senate, they bumped it up to 11.8. So when everybody thought it was going to go down, it went up. So this is a little bit of a hard thing to plan around. Yeah, so less than 1% of decedents owe an estate tax, according to the Tax Policy Center. But the really important facet that impacts everybody is the step up in basis. For income taxes, basis is the amount of an asset that when sold will be free of income tax. So give you a little bit of an example. When you first buy an asset, its basis is equal to its purchase price. So if Bob buys a piece of land for $100,000 and he sells that land for $125,000, his basis in the land is $100,000, and so his taxable gain is $25,000, the sales price minus the basis. When a person dies, his or her assets will receive a new basis in most assets equal to the market value on date of death. So why is this significant? And this goes to individual situations. So if I have a family who's wanting to, if I have a father and mother who want to gift their land to the son, let's say that's the path they've chosen. They have land that's worth $5 million. They bought it years ago for $100,000, and they want to gift it to their son or their daughter. And let's say, father has terminal cancer. We've been told he probably won't live more than a year. And this sounds very morbid, but these are the very real situations that we find ourselves in on a regular basis. And we have to deal with them, because it's also important to this father that the son continue in the business. My advice to them in that situation would be to set up a lease, to lease the land for 3 or 4 years with a purchase option. Why? If when the father passes away, he'll get a new basis. And so if that land that he bought for $100,000, if he gives it to his son before he dies, then it's as if the son bought it for $100,000, and someday when he sells it, he'll have $4.9 million worth of gain. Once mom or dad passes away, that it's as if that land got purchased for its current market value. So in that scenario I just gave you, once the father passes away, there's now 5 million in basis. The mom can then gift the land to the son. And now the son has $5 million of basis, which is 4.9 million more than he had before. And so the step up in basis is an important thing to consider. Now, if you're young and healthy, probably the potential growth of the estate outweighs the step up in basis argument. But that's why you have to kind of consider your own personal circumstances and consider all of those parts of the equation. So, and when you hear people talking about the gift tax and the estate tax, they kind of fall under the same general umbrella. If the exemption is currently at 13 million, you can gift up to 13 million while you're alive and not pay any gift tax. So the gift and the estate tax work hand in glove, and they use the same lifetime exemption. Okay, I think I covered everything I had, Jacob.
Thanks, Paul. You are obviously a wealth of knowledge on the subject, and that was a heck of a lot to get through in 40 minutes. You did a great job, and we appreciate it. We now have time for a couple questions. I see that a couple have come into our Q&A feature, but as we go through those, there's still time for those on the line to put in additional questions you might have. So feel free to do that. Paul, one that has come in is kind of around the subject of how one approaches this, maybe from a budgetary perspective. And I'm going to probably recognize that every situation is going to be different, but when engaging a financial individual like yourself, how might they start to think about a budget? Is it a per hour basis and everything is going to be different? But what kind of counsel do you have there?
Are you talking about as far as, how much is it going to cost when you bring in the team?
Yep.
Yeah, so it's not cheap. The attorneys, will typically run anywhere from $300 to $400 per hour. Accountants will run anywhere from usually $200 to $350 an hour. So I think as far as a budget of what it's going to cost, a lot of it depends on how clear of a picture you have of where you want to go. If you're just starting this and you just have no idea, it's going to take more time because you're going to take several meetings. And this is something that typically most of my clients, when they start on this, it ends up being a multi-year process. Usually my first conversation with a client is we talk about it when we do their tax return. And so we've spent 20 minutes, so it didn't cost them much. And then I take some notes, and then the next year when they come in, I'll ask them, hey, have you thought any more about what we talked about last year? And usually they have off and on, but that's kind of how the process goes. They wrestle with it a little bit. It gets to be too much, so they set it aside. Then when they set it aside, and then they come back to it. And then over a period of time, it starts to clarify to them what they want to do. I would say, again, I have clients that have spent $100,000 on their estate plan, and I have clients that have spent $5,000 on their estate plan. I would say there's very few that run up into the $100,000 range, and usually those are clients that have exceptionally high, $80 to $100 million net worth, which isn't most of my clients. Most of my clients are considerably below that. And so I would say most of my clients, the initial cost is probably anywhere from as little as $3,000 to 10 or 15,000. Now, if you start doing gifting and you've got to get appraisals done, then it gets more expensive. Because if you're going to be doing some gifting, a lot of times you have to get appraisals done in order to file the gift tax return. Those get expensive. But again, you can dovetail that sometimes with if you're already having an appraisal done for a real estate loan, you can use that as kind of a second purpose. So again, initially it's not very expensive because initially I think you're first going to be focusing on where do we want to go, and that's not a very expensive question. The question of where do we want to go, it doesn't cost a lot to get that going. It's gonna be one of the more challenging questions, but it's not going to be the most expensive. Then depending upon where you want to go, it can get very expensive or not at all. So, if you want to get basic, a living trust, that's going to cost you $2,000 or $3,000. And that's something you should do regardless of whether or not you're going to transition the business.
So it sounds like to set aside a healthy budget, and it is definitely money well spent.
It is. But again, start with the question of, I would not bring the attorney in, which is usually the most expensive component. I would not bring in the attorney or anything like that until you've got a clear vision of where it is you're trying to get to.
So Paul, that's actually a good segue to another question that we've received. I'm sure many of your clients are engaging with you on at least an annual basis for return prep. If for some reason they have not yet engaged in an estate planning attorney, what are some, what is counsel that you give them to things to look for in a good attorney, or not necessarily direct referrals, but how do they approach that?
Yeah, so that's a very important relationship. And so I would start with your account. If you have a good relationship with your accountant, ask them for 2 or 3 names, because some of it is personality also. You're going to be spending a little bit of time with this person, not weeks, but some time. And if you're going to spend that much time dealing with very sensitive matters, you need to be able to be in the room with somebody that you like being around, or that you at least don't hate being around. And there's some personality conflicts that can arise there. I know some very good attorneys who've had, just weren't a good fit with some of my clients, even though they were very competent, because of I could just tell there would be a personality clash. And so, if you have a good relationship with your accountant, or your banker, ask them, because they know you and they know some of these people. And so they can probably put you in touch with somebody that they've worked with before, who's done good work, and who they think would be able to work with you on a personal level.
That's great. Looks like we have another question, and I recognize this is probably borders on where we need some legal counsel, but maybe give an example if you've encountered it. How do you approach it if there's a situation where an individual seeks to keep assets such as land or liquidity in the family when spouses or their children have children from a previous marriage? So is that something you've encountered in the past?
Yeah. So yeah, that very much gets into the legal side. And so I got to be very careful putting on my legal hat, because it has a lot of holes in it. But typically the attorneys I work with, there's ways of protecting that. Usually it's through the entity structure and through the ownership structure. So anytime what they'll usually do is, for instance, you could put the real estate into an LLC or an LP, and that LLC or LP can be owned by as a separate property. You can sometimes have a separate property trust, and sometimes just owning it as separate property. But by doing that, usually the attorneys that I work with that explain this is, it helps to keep them in separate buckets. And then when you have it as separate property, it's then not subject to the community property laws. But then when they help you set that up, one of the flaws that I've seen happen is you need to follow those instructions. When they say don't commingle funds, it means don't commingle funds. And so, yeah, there's ways of accomplishing that. But usually it's through an entity structure and then owning it as separate property.
Definitely helpful. Well, Paul, I think that's what we have time for today. If our guests have questions for Paul directly, we've listed his contact information there. And as we talked about, your lender is one of those key individuals at the table in these succession planning conversations. So feel free to reach out to your lender if you have an established relationship, or if not, we'd be happy to work with you, and our contact number is listed at the bottom of the screen. But Paul, thank you for your time again today, and thank you for everyone for joining. Enjoy the rest of your day.
Thank you.